From San Francisco, I'm Taylor Riggs in for Scarlett Fu, and this is Bloomberg ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Tesla on a tear as the stock hits a record high. Ultra Bull Cathie Wood enters the ring for a bear versus bull debate. The automaker is also sending one low-carbon ETF to heights it hasn't seen in more than a decade. And Cathie Wood also brings us some stock picks that rival her excitement for Tesla. But before we get a look at Tesla, we want to get started on the big themes of the week. I want to bring in Bloomberg Intelligence ETF analyst Alec Balchunas, who has a snapshot of flows. Eric, what are we looking at?
Thank you, Taylor. Yeah, so it's a mixed bag. And in fact, there's some nerves creeping in, some early 2019 kind of nerves. Before I get to that, SPLG, I want to point out, this is a new one you don't see very often. Spider basically made this ETF track the S&P 500 and then lowered its fee to 3 basis points to compete with VU and IVV, and it's really off to a good start. $4 billion. It's kind of a knockoff of SPY doing well. But look, you've got utilities, you've got bonds, you've got treasuries, you've got gold, you've got low vol. That's some nerves creeping in here in this market. Let's look at the outflows, which also show some nerves as well, because we've got about $3.5 billion out of SPY. We've got JNK seeing some outflows, right? IVV in here, even XLF. So definitely people are nervous. But if you want some good news, and I do think overall people are bullish, just look at the tech sector. The flows into tech ETFs are just rampant, right? They've taken in about $3 billion in February, and the month isn't even over. And you can see that would be the most in over a year easily. And look at the last 2 months. So this is a lot of people running into tech, and why wouldn't they? Tech is doubling the market this year. So Taylor, there is some nervousness, but largely people are bullish on tech, and that's a good sign.
Well, thank you to Eric Balchunas. And this week's roundtable features Cathie Wood. She's founder, CEO, and CIO of ARK Investment Management, and Katie Greifeld, a cross-asset reporter for Bloomberg News. I want to start with you, Cathie Wood. I mean, you just heard Eric Balchunas there and sort of on the massive tech rally that we've seen. If it's not coronavirus, what is it that slows down or stops this rally?
That's a very good question. We've been climbing the wall of worry, and as Eric just mentioned, we're still seeing outflows in many of the equity funds. So I actually love this dynamic as a portfolio manager. The fear associated with, once again, flattening to inverted yield curves, coronavirus, this serious slowdown in manufacturing, some of the earnings disappointments we're seeing. This market is climbing a wall of worry. Those are usually the strongest bull markets. That's not to say we won't have a correction. I don't want to suggest that at all, but I really do believe this is a very strong bull market, and I also believe it could last for years.
And Katie, I want to bring you into this. I saw over the weekend, Apple reported sales declining. I thought, okay, this is it. We're going to at least have a bad week. But it's just not showing up. What are you seeing when you really dig into other tech ETFs?
Well, there's really not any evidence to speak of that Apple warning had a broader impact. I mean, yesterday in particular, you had Netflix, Amazon, Facebook all come in to save the day. Of course, Apple's rallying today, so it's kind of like the rally that doesn't stop. And, if you zero into the ETF flows, we were really looking for evidence. Obviously you want to write about the news of the day, but it really wasn't there. You saw a little bit of a reaction in SOX, that's the iShares chipmaker heavy ETF. Trading surged there by the most in about 2 years, but at the end of the day, that was only 26 million in outflows, which really isn't anything to write home about for a fund of this size.
Cathie, you are known in part because of your big bull call on Tesla. We're going to get to Tesla later. In the meantime, though, there are some stocks that give you the same amount of excitement that you find as well from Tesla. What are some of those other stocks that give you that same excitement?
Well, if you look at our portfolios, the top 10 in our portfolios, you'll find a disproportionate weighting in healthcare. Now, that sounds odd because we're talking about technology here, but these companies are technologically enabled, and they're going to transform healthcare. So in the gene editing space, we own all 3 of the stocks with the foundational patents in our flagship portfolio and in our genomics portfolio. So those are CRISPR Therapeutics, Intellia, and Editas. Now these 3 stocks together their market caps collectively are a little more than $5 billion, roughly, right now. If I had told you in the late 90s that there were 3 stocks with the foundational patents to a technology that was going to cure disease, actually cure it, not just treat symptoms, but cure, my guess is the 3 collectively would have accumulated to $200 or $300 billion in market cap. Instead, we have $5 billion. Apple at $1.5 billion is a great stock. It's transformed our lives, sure, but it's not curing disease. We think there's huge inefficiency in the new biotech space. Illumina is the godfather of this space. Gene editing wouldn't mean anything if we couldn't identify the mutations in our genomes. So now that we can identify the mutations, we're going to be able to edit and correct those programming errors. So healthcare is a surprisingly large part of our portfolio, almost 35%. And then fintech would be another big part of our portfolio. Our most exciting stock there is Square. We think that while Venmo gets all of the attention for its peer-to-peer lending or peer-to-peer capabilities in Venmo, PayPal's Venmo, we think the Cash App is as powerful, if not more powerful. If you look at the searches that are taking place now on Google, Cash App is getting a disproportionate share.
And Katie, look, all these stocks are tech-y, but they're not in the tech sector. And Kathy may have started, but there's a lot of copycats, and they're actually kind of riding her coattails pretty well, right?
Yeah, it's kind of funny. You've seen, D-Tech, XT, Comp jump to mind that are trying to ride this disruptor wave. They all launched post-2014, so after ARK came to market. But I want to hone in on Comp because it looks a lot like ARK. I mean, again, it has this disruptor flavor. Its biggest holding is Tesla. And it's really ridden this boom. It's pulled in over $400 million in February alone, which is just massive relative to its size. It's just over $500 million, and it was a lot less about a month ago.
Well, our thank you to Bloomberg's Katie Greifeld and Kathy Wood of ARK Investment Management will be sticking around with us. Because coming up next, Wall Street's biggest Tesla bull, Kathy Wood, takes on a Tesla skeptic, Edward Niedermeyer. That debate is coming up. And 2 ETFs that caught our attention this week, the Vanguard S&P 500 ETF, that's ticker VOO, and the Spider S&P 500 ETF Trust, also known as SPY. Warren Buffett's Berkshire Hathaway disclosed investments in both funds, totaling $25 million in the final quarter of 2019. And as a reminder that you can catch all of our charts on the Bloomberg terminal at GTV. This is ETF IQ. I'm Taylor Riggs in San Francisco, and this is Bloomberg ETF IQ. Let's get to the ETF Lifecycle, where we run you through the 3 main stages of ETFs. Step 1 is the filing. Van Eck has filed for the Sustainable Muni ETF. The ETF will be actively managed and invest in investment-grade muni bonds. The fund will have an ESG focus, investing in bonds for projects helping to promote progress towards sustainable development. Step 2 is the launch. The ARMR U.S. Equity Index ETF is now trading under ticker ARMR. The fund is passively managed and will invest in sector ETFs. The strategy attempts to select the funds or sectors most likely to generate positive returns while managing downside risk. And for some, that final stage is liquidation. Invesco Shipping ETF, the ticker C. The fund was passively managed and invested globally in companies focused on the shipping of freight. It had peak assets of $135 million back in 2014. Time now for a bear and bull debate on Tesla. The stock has been on an electrifying run in 2020, hitting another record high. Our bull in this battle, it is Kathy Wood, founder, CEO, and CIO of ARK Investment Management. And our bear in the debate is Edward Niedermeyer. He is author of The Ludicrous, The Unvarnished Story of Tesla Motors. Kathy, let me start with you. Known for your very bull case scenario here, $7,000 a share on Tesla by 2024. What gets you to $7,000?
There are a number of variables that get us there. The first is our forecast for electric vehicles in 2024 is 34 million units, up from roughly 2 million last year. So that right there is an exponential growth rate. The second is our gross margin assumption. We are using Wright's Law, which you may have heard us discuss before. Wright's Law gets us from roughly 20% on auto margins in the fourth quarter to roughly 40% during the next 5 years. And then we're also looking at capital efficiency. Capital efficiency, we see now from Shanghai that Tesla can build a car for roughly $1,000 in capital spending per unit. That is one of the lowest rates out there. And finally, our belief that Tesla is furthest ahead in autonomous capability. So in that forecast, we have a 25% chance or probability that Tesla will launch an autonomous taxi network within the next 5 years.
So Ed, let me bring you in here because this strikes home for a lot of people, this ability for autonomous driving. Are we not yet at level 5, or is Tesla not yet leading the way on level 5?
Yeah, so I mean, I think I agree that actually autonomous drive technology is really kind of the key issue here, because I don't see how Tesla can sort of justify its current valuation as an auto manufacturer. And there are other issues with EV forecasts that we can get into too. But I think autonomous is the key issue here, because that's the only way they get out of Wright's Law aside, what is fundamentally a capital intensive, low margin business. But when you look at Tesla, its approach to autonomy is very, very different than basically everybody else in the space. They're taking money, they're selling cars into private ownership. They're using a very limited sensor suite in order to make that vehicle affordable. And they're promising that it can do level 5, when basically all the other full autonomy developers are focused on level 4, which means sort of developing a system to be used within a specific geofence and as a robo-taxi fleet, for example, in one city. I think, you know, if we're sort of at the you know, Kitty Hawk stage of autonomous vehicles, with I was recently in a Waymo that was fully driverless. You know, I think Tesla is sort of like a guy who's putting down or accepting deposits for like an F-35. What they're promising is so disconnected from where everybody else in the space is. It just doesn't seem plausible.
Kathy, another point that you mentioned on was their margins. Are you fully confident that Tesla is able to be profitable really from here on out?
Yes, on average, on balance, yes. I'd just like to address the autonomous points that Edward made. So autonomous is an artificial intelligence project. Tesla is taking a leaf from Apple's book here. Apple was moving the smartphone market ahead so quickly, so much more quickly than Nokia, Ericsson, and Motorola, that it had to design its own chip. And the rest is history. Tesla is the only auto manufacturer to have designed its own AI chip. And our analyst, our AI analyst, James Wang, who spent 9 years at NVIDIA, took a look at the specs of that chip and said, Tesla is 4 years ahead of any other autonomous or auto manufacturer. The other way it's ahead is with data. The winner in an AI project has the most data and the highest quality data. Tesla has 14 billion plus miles of real-world driving data, while Waymo, the closest competitor in this regard, has 20 million, 14 billion, 20 million, and Tesla has 700,000 cars out on the roads. You could consider them robots collecting this data and sending it back every night. And they have the best AI team, we believe, not just in the auto industry, but maybe in almost any industry.
Right. Ed, final question here to you. Are you doubting Tesla's ability to be profitable from here on out?
Look, I think that they have a lot on their plate that they have to pay for. They have a couple of products, the Semi, the Roadster, and the Model Y, which all have to come out this year. They're building this factory. They're building a factory in Germany that's going to be a lot more expensive. They have a lot to do. And the problem with sort of approaching Tesla as a tech company, people imagine that as like a software company where you sort of make a certain amount of fixed cost investment, and once that's amortized, the variable cost of each additional copy you sell is almost nothing. You know, the auto industry simply isn't like that. And where we see, and Tesla is very easy to understand in terms of these stories, but the problem is that this is not a seed stage startup. This is a company with a track record, and the operational fitness required to be sustainably profitable in this really brutally tough business, is one of habits. This is what we've learned from Toyota. It's about culture, and so you can't just flip a switch and say we're going to be profitable now. It's about developing a culture of continuous improvement and really detail focused, and I just haven't seen that track record there. So between that lack of operational sort of fitness and the huge expenses that they have to deliver on what they've already promised, I think it can be very difficult for them to be profitable sustainably.
Next time I vote that this is going to be a 3-hour roundtable. So my big thank you to Edward Niedermeyer and Kathy Wood there of ARK Investments. And speaking of Tesla, don't forget to tune in this weekend to the Bloomberg special EVs on the Brink of Change, hosted by Alex Steele. And coming up next on IQ, we continue our Tesla theme as we dig into a low-carbon ETF that is fueled by the automaker's rally. This is Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Taylor Riggs. Now, for every ETF that offers exposure to an asset class, sector, country, or style, it's not long before others promise the same. This week, we dig into risk parity. Eric Balchunas is back with us with the details. Eric, what are we looking at?
Yeah, so risk parity, it's a hedge fund strategy. They've attempted to democratize it by putting in this ETF. Holds other ETFs in a variety of asset classes like equities, commodities, tips, treasuries. The goal is that you're basically using risk to determine the weighting. So let's look at the holdings here of this, which, by the way, is 170 million, pretty big for a new fund. That's why we're kind of looking at it this week. And you can see it's a real, pile-on of different securities here, ETFs, individual securities. But again, it's all different asset classes. Now let's look at how it performs versus the other risk parity ETF that's in Canada from Horizons and the S&P. So if you go into something like this is the fund we're looking at today. This is the S&P, but this is 1/4 the volatility of the S&P. And here's the one from Canada, which leans Canadian. That's why it's trailing. So Taylor, this is kind of like a hedge fund strategy for 50 bips, and I think that's the value add here. Question is if you look at the S&P, it could be a little hard to watch.
Well, with us now to discuss this ETF, it is Alec Shahidi. He's a partner at Advanced Research Investment Solutions. He joins us now from Los Angeles. Alex, walk me through how a risk parity ETF fits into a broader portfolio that may have other risk characteristics in it.
Sure. Most investors are slotting it into the alternatives category, similar to other multi-asset strategies.
Yeah, when I talk about this fund with people, they'll go, well, this is fine, but you really need to leverage up here. I think you guys are 20% leverage. They'll say you need to go way beyond that to feel the oomph of a risk parity strategy, and you're not getting it in the ETF. What do you say to that?
Well, there's really two levers, and this particularly applies to the fixed income portion, the treasuries and the tips. There are two levers to increase risk. One is leverage, as you mentioned. The other is to have longer duration. So the bonds that we own are longer duration treasuries and tips. So between the two, you can get an equity-like risk without using a lot of leverage.
Do retail investors understand the idea of risk parity, or is this an institutional investor knowledge base?
Well, many of the investors in this ETF are retail, high net worth individuals. And I think the concept of risk parity is going to become more popular over time. So I think they do understand it, and I think they'll understand it better as perhaps the next bear market arrives.
Speaking of which, we've seen this situation where everything goes up or everything goes down. Will that affect this new era? Will that affect the returns of a strategy like this? Is the data used to that kind of a scenario?
Well, I think that happens occasionally, but those environments tend to be short-lived. If you look at over longer periods of time, these assets tend to go up and down in different environments, and particularly during major market dislocations when you need diversification the most. For example, in Q4 2018, 2011, and then particularly in 2008, the safe haven assets, treasuries and gold, actually did quite well in those environments when many other assets sold off.
Alex, what do you do when the Fed comes in, as they have in the last decade, and everything is correlated on a 0.5 to +1 basis, and you don't get assets that are no longer uncorrelated?
Well, I think you do get that real diversification benefit during those major dislocations that I just mentioned. So Q4 2018 is the most recent example of that. Treasuries actually rallied. Gold did really well in that environment, and that was a period when the Fed was working with the market in terms of moving interest rates.
Well, our thank you to Alec Shahidi. He's a partner at Advanced Research Investment Solutions. Now, the ETF industry has something for everyone. In this week's There's an ETF for That, we highlight a fund that helps you reduce the carbon footprint of your portfolio.
Going green is starting to pay off. Assets in ESG and values-based ETFs climbed to $94 billion in 2019, twice the previous year's level. One fund looking to capitalize on this surge in interest, the VanEck Vector's Low Carbon Energy ETF, or SMOG. The fund tracks companies primarily engaged in the business of alternative energy. Companies must get at least half their revenue from low carbon energy, which is power derived principally from biofuels, wind, solar, hydro, and geothermal sources, and includes the various technology that supports these sources. SMOG has some 30 names, but the star is Tesla. Elon Musk's electric vehicle maker makes up around 15% of the fund. Tesla is the main engine driving SMOG's performance, single-handedly accounting for 40% of the fund's total return over the past year. The rest of SMOG's market cap-weighted names include Eaton, Microchip Technology, Vestas Wind Systems, and Ametek. SMOG has around $115 million in assets and an expense ratio of 63 basis points. It gets a green light in the Bloomberg Intelligence traffic light system.
So, Eric, final thoughts. Tech rally here to stay?
Yeah, I think so. It's relentless. Every time people talk about betting against it, they get hurt. So eventually it will end, but who knows when? That's the million-dollar question.
Don't fight the tech rally. That does it now this week's for Bloomberg ETF IQ. Make sure to catch us each Wednesday, 1 p.m. New York time, 6 p.m. in London. This is Bloomberg.